Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We're about to dive deep into the week's most impactful financial stories and market movers. Our goal, like always, is to cut through the noise, grab those really important nuggets of knowledge, and hopefully uncover some surprising facts that'll get you well-informed fast.
Absolutely. And we've got a lot to cover today, drawing on some great reporting from places like Bloomberg and CNBC. We'll be looking at everything from, well, a pretty startling tech surge in Asia, focusing on Alibaba and AI, right through to global trade issues, think tariffs, chip wars. It's all heating up. And we'll look at how that's playing out across different markets. It's a really interconnected picture we're trying to paint.
Definitely interconnected. So yeah, our mission today: slice through the overload, deliver the key insights you need to understand what's really shaping the global financial world right now. Let's get into it.
Okay, let's kick things off with that headline from Asia you mentioned. Alibaba's recent surge is pretty remarkable. Bloomberg had his Hong Kong stock leaping over 19% in just one day.
19%.
Yeah, adding something like, what, over $50 billion to its market value?
That's right, huge numbers.
It's their biggest single-day gain since late 2022. But here's the interesting part, right? It's not really about their main business.
No, exactly. The real story here, and it's a fascinating look at how these tech giants are trying to pivot, isn't about e-commerce. It's about AI. The core driver, and CNBC reported this clearly, is Alibaba making real strides in artificial intelligence. They saw a triple-digit percentage gain in AI-related product revenue. That's huge growth.
Triple digits, wow. Yeah. And that came alongside a better-than-expected 26% jump in sales from their cloud division. And that cloud business is the part most closely tied to this whole AI boom. So it's less a pivot, more like a strategic re-engineering.
That's a really key distinction. So with this big shift, how are the analysts reacting? Are they buying into this AI future over the e-commerce headwinds?
Well, they're definitely paying attention. Charu Chana over at Saxa Markets, she noted, this shows Alibaba repositioning for longer-term relevance in the tech stack, not just retail dominance. That's a direct quote.
Interesting phrasing, tech stack relevance.
Exactly. And Morgan Stanley, folks like Gary Yu there, they're even talking about a China's best AI enabler thesis for Alibaba. Plus, you've got the CEO, Eddie Wu, who apparently declared back in February that artificial general intelligence, AGI, is now the company's #1 goal.
AGI, that's the really advanced stuff. AI doing anything a human can intellectually.
That's the ambition.
That is a bold statement, especially given how competitive it is. So what are these AI investments actually looking like? Can they realistically challenge the big global players?
Well, digging in, Alibaba's developing a whole range of AI tech. You've got large language models like everyone else, but also open source video generators. These things called agentic AI services.
Agentic AI, like AI agents that act on their own.
Kind of. Think super smart digital assistants that can tackle complex goals autonomously. And chatbots, of course. They're definitely aiming to compete with OpenAI, but also local Chinese rivals like DeepSeek. But, and this is the big but that Bloomberg pointed out, the challenge is turning all this cool tech into a money spinner, especially when you've got Baidu and Tencent breathing down your neck, rolling out their own AI models like crazy. It's an incredibly crowded space right now.
Sounds intense. But this AI success story, as you hinted, it kind of masks some other issues for Alibaba, doesn't it? It feels like maybe a useful distraction from the e-commerce fight.
You're right on the money there. While Alibaba's AI side is getting all this positive attention, their traditional competitors, Meituan and JD.com, they're really struggling. JD's profit actually halved recently. Halved.
Oh.
And Meituan warned about potentially major losses ahead. So, this whole situation led to a huge sell-off for those three, Alibaba, Meituan, JD, just last week. Bloomberg put the figure at around $27 billion wiped off their combined value. So yeah, AI looks great for Alibaba, but the old e-commerce battleground is frankly brutal.
So we're seeing this clear split then. Alibaba's AI and cloud growth seems real, not just hype, but the wider China tech scene is still pretty mixed.
Precisely. Chana from Saxo captured it well again, saying it's real revenue growth in AI and cloud, showing a divergence is real within China tech. Oh, and CNBC also mentioned that Alibaba is apparently developing a new AI chip, which likely added fuel to that share price rally. So for you, the listener, why does this matter? It really shows how fast these old-school e-commerce giants are betting the farm on next-gen tech to stay relevant, and it highlights just how fierce and complex the competition is within China's tech sector. It's definitely a space to watch closely.
Okay, let's shift gears now from China's internal tech battles to the pretty messy global trade picture. Specifically, let's look at what's happening with U.S. tariffs. This story's been bubbling up across CNBC and Yahoo Finance.
Yeah, a really big piece of news here came on Friday from the U.S. Court of Appeals for the Federal Circuit. They ruled that most of President Trump's so-called reciprocal tariffs are actually illegal.
Illegal. On what grounds?
The court said it was an overreach of his authority under that 1977 law, the International Emergency Economic Powers Act, or IEEPA. Basically, that act gives the president power in emergencies, but the court felt these specific tariffs went too far. Now, importantly, these tariffs don't disappear overnight. They can stay in place until October 14th, giving the administration a window to appeal to the Supreme Court.
And the reaction to that ruling was strong. I saw Peter Navarro, the White House trade advisor, quoted on CNBC calling it weaponized partisan injustice. He even warned it could mean the end of the United States if the tariffs get blocked. That's pretty intense language for a trade ruling.
It certainly is strong language.
So beyond the rhetoric, what are the actual practical effects here? For businesses, for us as consumers.
Right. What's really at stake? Well, according to the Tax Foundation, these tariffs, if they stay, affect about 69% of goods imported into the U.S. If they get blocked, that drops to maybe 16%. But here's the thing for you to remember. These duties, they're almost always paid by American consumers in the end.
Right. Companies just pass the cost on.
Exactly. But maybe even more damaging than the direct cost is the uncertainty this legal back and forth creates. That constant will they, won't they is really tough for businesses trying to plan. And it could put a damper on market hopes for September, which, is already usually the weakest month for the S&P 500 historically. It's that lack of clarity that spooks the market.
And this trade uncertainty, it spills over directly into other areas, like the intensifying chip war, right? Bloomberg reported the Trump administration just revoked China chip permits for Samsung and SK Hynix. What's the impact of that?
Oh, that's a major blow. It makes it much, much harder for those two giants, the world's biggest memory chip makers, to ship critical manufacturing equipment into their facilities in China.
So it hits their production there.
Directly. And it hampers Beijing's access to crucial technology. The market reaction was immediate, as you'd expect. Samsung shares dropped over 2%, SK Hynix down over 4%. And their suppliers, companies like Advantis and Disco Corp, they fell hard too. Bloomberg tracked those falls. This move really feeds into China's big push for techno-indigenization.
Right, their drive to build up their own domestic tech industry.
Exactly. Beijing wants to cut its reliance on foreign tech, especially chips. So you see local players like Cambricon Technologies getting a boost, positioned as NVIDIA alternatives. And President Xi himself, according to CNBC, has basically declared making their own AI hardware and software a top national priority.
And speaking of NVIDIA, how are they navigating this? It sounds like a really tricky spot for them.
It is. Extremely tricky. Their latest earnings call, which CNBC covered, revealed basically zero revenue from their special China-focused H20 chip in the second quarter.
Zero.
Zero. And they're assuming zero for Q3 as well, explicitly citing geopolitical issues. I remember those comments from Commerce Secretary Howard Lutnick a while back, suggesting the U.S. strategy was just to get China addicted to slightly older tech.
Yeah, that caused a stir.
Predictably, that kind of talk just poured fuel on the fire in China. It boosted nationalist sentiment, pushed companies even harder towards domestic chips away from foreign suppliers like NVIDIA. So for you listening, this whole mess really shows how these big geopolitical games and trade policies have real, tangible effects. It hits supply chains, tech companies, and ultimately, it influences the prices you pay and makes markets more volatile. It's not just abstract politics.
Okay, let's widen the lens again. Now look across Asia more broadly. Markets, there have been a real mixed bag this past week, haven't they?
They really have. Lots of different currents. First, though, a bit of potentially good news out of China. That private manufacturing survey, the Rating Dog one, actually expanded in August. It came in at 50.5, up from 49.5.
Above 50 means expansion, right?
Exactly. It beat estimates, which CNBC noted and maybe points to some underlying resilience, a potential bounce back in their manufacturing, despite other headwinds.
Okay, and on the diplomatic side, Xi Jinping was at that Shanghai Cooperation Organization Summit, the SCO. What was the message there?
Well, according to CNBC, he was pushing for AI cooperation, interestingly, and also explicitly rejecting a Cold War mentality. This fits into China's broader effort lately to position itself as a kind of global peacemaker.
And geopolitically, that summit was significant. He met with India's Modi and Russia's Putin.
Yes, those meetings were key. And notably, China and India apparently agreed to be development partners, not rivals. That specific wording, partners, not rivals, reported by CNBC, is quite deliberate. Now, this is really complicated for India. They're dealing with that hefty 50% U.S. tariff, remember? The one Trump imposed, mainly seen as pressure over buying Russian oil.
And they've been accused of profiting from that Russian oil.
Exactly, accusations of profiteering. But India's oil minister, Hardeep Singh Puri, pushed back hard against that in an editorial for the Hindu newspaper. He argued India is acting legally and actually helping stabilize global oil prices. So India is performing this tricky balancing act between the U.S., Russia, and China.
Okay, turning to India's economy itself. Growth looks strong on paper, right? 7.8% GDP recently.
Headline growth is strong, yes. But Reuters dug into the details, pointing out that nominal growth actually fell. And corporate earnings growth. That's hit a 7-quarter low.
So underlying weaknesses despite the headline number.
Precisely. And that combination seems to be making foreign investors nervous. They've pulled out $15 billion so far this year. And a big chunk of that, $4 billion, came out just in August, which analysts directly link back to those U.S. tariffs still hanging over them. Shows how external factors bite.
And elsewhere in Asia, not all smooth sailing either.
Definitely not. Look at BYD, the big EV maker. Their Hong Kong shares, according to CNBC, dropped almost 8% after Q2 profit slumped by 30%.
Why the slump?
Mainly that brutal EV price war happening in China. Retail car prices there have plunged about 19% in just 2 years. It's a race to the bottom, squeezing everyone's margins.
Wow, 19%.
Yeah. And it's not just China. Even Tesla saw its registrations in Sweden collapse by 84% in August. Huge drop. Shows how fast EV market dynamics can shift. Then you've got Indonesia. Their market and currency, the rupiah, took a hit because of widespread protests over living costs and, believe it or not, lawmakers' high pay.
Social unrest hitting the markets.
Yes, but interestingly, economists quoted by CNBC still feel Indonesia's long-term growth prospects look okay, despite the current turmoil. So it just underlines that complex mix across Asia, economic data, geopolitics, domestic issues, all shaping how markets perform region by region.
All right, let's bring it westward now. A quick look at Europe and the U.S. markets as we head into, well, what's often a tricky month for investors.
Okay, Europe first. Markets there were generally mixed, according to Bloomberg's reporting. One standout positive was Novo Nordisk. Their shares jumped 3%. Why? Their big weight loss drug, Wegovy, showed really positive results in reducing heart disease risk. That's a big deal, medically and for the market, as CNBC detailed.
Good news for them. Any sector struggling?
Media stocks have had a rough time, down over 8% in the last couple of months. Part of that seems to be nerves about how AI might disrupt their business models. It shows how these tech shifts create winners and losers everywhere.
And here in the U.S., markets were closed yesterday for Labor Day, but now we're staring down September. Historically, Wall Street's least loved month, as they say. Why is that again? Just end of summer blues?
Maybe partly. But yeah, often it's things like big investors rebalancing portfolios, maybe a lack of strong seasonal news, sometimes profit-taking after summer gains.
Okay, so what are investors going to be watching like hawks this month?
So what's really going to drive things, all eyes will be on the upcoming jobs numbers, obviously crucial inflation data, and then the big one, the Federal Reserve's decision on interest rates. Their next meeting is September 16th and 17th.
And the mood music from the Fed recently.
Well, Fed Chair Jerome Powell gave a speech recently that many interpreted as slightly dovish tilting, leaning towards maybe easing off hikes, possibly even cutting rates down the line. CNBC highlighted this. That little bit of optimism actually fueled a rally in precious metals. Silver popped above $40 an ounce, first time since 2011, and gold's getting close to its all-time high again.
Interesting. So those Fed signals are key.
Absolutely crucial. These indicators, jobs, inflation, Fed action, they're really going to set the tone for the market for the rest of this year. So for you, watching these global moves, understanding how they all connect, that's really key to navigating your own financial plans right now.
Wow. What an incredibly packed start to the week, looking across these global markets from, AI completely changing valuations in China to the ripple effects of U.S. tariff rulings, those subtle hints from central banks. It's never been clear how linked everything is.
It really hasn't. And this deep dive, I think, shows that, well, yeah, markets react to hard numbers. They're also deeply swayed by policy choices, by geopolitical shifts, and these huge technological waves like AI. So the question for you, really, as you think about all this is, how will these powerful undercurrents keep shaping things for investors, for businesses, for innovators in the months ahead? What are the new opportunities or maybe the new challenges that might emerge from all this?
That's a great question to chew on. Thank you for joining us on this deep dive into the latest headlines today. We really hope you feel a bit more informed, maybe a bit more ready to tackle the week ahead. We'll see you all tomorrow morning with new headlines from major financial magazines.